Coming up today, stocks pull back, Bitcoin tumbles to 85,000. What's rattling the markets? Has the biggest crash in history just started? The latest holiday shopping data, a new Fed chair on deck, JP Morgan's 2026 outlook, and Max Payne hits the crypto markets again today. We're here to have a good one, guys. Let's go. And welcome back, guys, on yet another interesting day in markets. I wasn't going to do a show today, but I've already got a lot of people asking me for my opinion on the big moves in crypto. So I thought I'd give all you guys an update. So sit back, lock in, and let me get you up to scratch on what's going on out there, along with my thoughts about it all. So as you've probably already noticed, crypto is getting hit hard again today. Big fall in Bitcoin and Ethereum. Whilst at the same time, we've got silver ripping, along with a bit of weakness across tech and most stock sectors out there. But it's kicking off with the biggest news in financial markets today, the deepening sell-off in crypto. Some of you guys may remember last week, I said I was expecting a retest of these lows, setting up for a potential double bottom and bullish divergence on the charts, as we can see in my DSI indicator, setting up for that technical bullish divergence. As we didn't really have a strong bounce the last week and a half, we didn't get that big face ripper, solid green candle to really wash out this downtrend. Pretty much similar story on Ethereum as well. Almost back down to the lows from 2 weeks ago, before we found a little bit of support in late afternoon trading today. And so I'm noticing some interesting patterns out there. Just looking here at the relative value of Bitcoin versus the NASDAQ index on the weekly chart, as both crypto and tech stocks are sensitive to risk-on factors, interest rates, liquidity, and general sentiment in the market. And what I can see here is the fifth consecutive bullish arrow on my reversal signals indicator here on the weekly chart, something that's never happened before. In fact, in its entire history, we've only ever seen one bullish arrow on this spread chart between Bitcoin and the NASDAQ, and that was back in January 2015, more than 10 years ago, which was actually a great time to buy the dip on Bitcoin. And whilst we've seen plenty of bearish reversal signals showing Bitcoin can quite often get extended on the upside versus tech stocks, we've never seen Bitcoin so extended on the downside versus tech stocks as what we're seeing right this minute. And in fact, just looking on a shorter time frame, the 3-day chart, kind of a half weekly chart, we're seeing the same thing. Really oversold conditions that we've rarely seen before. We have to go back to July last year to see a similar technically oversold condition of crypto versus tech stock. And so why is Bitcoin and crypto selling off so hard yet again today? Well, I think it's a continuation of the washout in leveraged bets and traders in this market. First kicked off by fears we're not going to get an interest rate cut next week. However, that's now been priced in as a near 90% chance that we will. So I think this initial profit taking and fears that we're not going to get an interest rate cut has been exacerbated into a full-on kind of meltdown and washout in the crypto market. We just got news, another $1 billion of crypto positions were liquidated during the sharp sell-off to start this week, with initial stats coming in, over 200,000 crypto traders had their accounts liquidated in the past 24 hours, as this sell-off kicked off last night as soon as futures opened for trading. And again, this was kicked off last month, not just with retail traders, but with crypto market makers, the companies and hedge funds that actually provide liquidity to the market, as they too use a lot of leverage to hold positions in the market. So these big outsized moves can catch even large funds off guard. But there was also news coming out of Japan today that may have exacerbated it even further. We just heard the Japanese central bank raise the prospect of hiking rate this month, as their economy is still dealing with a lot of structural inflation, something they're not used to. That's been around for a couple of years now, and even just going to a one-year chart, we're not seeing it spike too crazy right here and now, but they're still feeling the persistent effects of 3% inflation, as their interest rates are still normalizing. After years of sitting at rock bottom lows, there's still a big gap between where their rates are and inflation. Ideally, you should always have rates a little bit above inflation. And so we can see JGBs, Japanese government bonds, breaking out here today and just going out to a 3-monthly chart. Now getting back to 2007 levels. Like I said, they went crazy low, even negative yields just 5 years ago. So we have seen this sharp increase in Japanese bond yields today, along with a little bit of a bump up in global bond, looking at the US 10-year, but still in a downtrend. The British 10-year, little bump up, but still consolidating. Same deal with European bond yields, Canada and Australia as well, having a little bit of a bump up, possibly putting pressure on the crypto market again. But looking across other markets for clues, we're not seeing huge signs of distress. Looking at the Japanese stock ETF traded on New York under ticker symbol EWJ, pretty much finishing flat there today, just off a little bit. No real heightened volatility or volume. Same with the dollar yen as well, just coming off a little bit there today. But overall, the dollar is still in an uptrend versus the yen. In other words, the market's not rushing out to buy the yen or cover shorts on the famous yen carry trade. I think a lot of people get carried away with that narrative and rhetoric, talking as if the whole global financial system runs on top of the yen carry trade. For those of you who don't know, a lot of funds and traders borrow in yen due to their really low interest rate relative to the world, then invest in Japanese stocks, American stocks, other risk on assets. And so when Japanese interest rates go up, some of those leveraged bets are forced to unwind. No doubt that does have some sort of an effect in the short term, but current estimates show yen-dominated claims to offshore financial centers is sitting in somewhere around 600 billion versus the 63 trillion US equity market. In other words, which is about 100 times bigger than the yen carry trade. But definitely more sensitive is the crypto market, now currently at 2.9 trillion, which is much more volatile than stocks. And so whilst yes, climbing Japanese bond yields can cause a little bit of unwinding, it's not a reason for a big systemic structural crash of the entire crypto or global stock market. I think another headline today, spooking fears across the crypto market, was more news out from China and their central bank reaffirming their crypto ban, and this time warning it's going to intensify its crackdown on stablecoins. Coming at the same time, the US government is stepping up their backing of crypto and stablecoin, with the digital market structure bill up on deck and the potential for a US strategic reserve that includes Bitcoin and other cryptos. And so while on the surface this may appear to be bearish, I think it's actually bullish for crypto in the medium and long term, because the more China's against it, the more it turns into kind of a geopolitical football and makes the American government more likely to back it, and definitely creates a big distinction in how finance and transactions in general will run between the two biggest economies in the world. And so the reason China doesn't like it is because they can't control it. That's the whole point of crypto, being decentralized. And so being an authoritarian communist government, they like to have a tight grip on everything. And so it's very hard for them to embrace crypto, but that could be to their disadvantage in the long run, because finance in the world in general is moving closer and closer to running on the blockchain and the tokenization of assets. It's a much more efficient way to move money around. But alas, the fear is real. Just to give you guys a taste of the sentiment across social media coming from crypto traders today. Got a few posts here today. This guy who's apparently been listed on the Forbes Asia 30 under 30 list, saying this is worse than a bear market. This is torture, and seeming to be quite emotional, like a lot of people are whenever we see this kind of price action. But it is producing some classic meme. Bitcoin last month, similar to Sydney Sweeney. Bitcoin now, similar to Greta Thunberg. Another guy, hopefully he's joking. I just turned 2 million into 1,200. Ask me anything. This guy here. Happy December, everybody. Along with this meme showing a comfortable commodity trader with gold and silver ripping, lending a helping hand to the struggling crypto trade. And here's a good one. When the family you told to buy crypto at Thanksgiving sees you at Christmas. No doubt, we've probably seen plenty of that. Even famous book author Robert Kiyosaki warns the biggest crash in history is starting, says millions of people will lose everything, with this headline making the round across media today. How to prepare now, including buying his book, which does convince a lot of people out there, because people think, wow, this guy, he's popular, he's an expert, he's telling everybody the big crash has already started. Some people may not realize he said the same thing back in 2022. Biggest crash in world history is on its way. And again in 2017, the market is about to crash. In fact, he wrote a book about it all the way back in 2013, why the biggest stock market crash in history is still coming and how you can prepare yourself and profit from it. In my opinion, this is just another clown making money by selling fear, which, as we know from the mainstream media, works really well. But how much money has this guy scared out of the market for his own benefit? Now, whilst nobody can see the future, anything can happen in markets. That's why it's important you be diversified. Don't trade on margin. Only put on trades you can handle to lose. I believe there's a big disconnect at the moment between the fundamentals and technicals of crypto. We've got the most bullish crypto government we've ever seen, who could very well start buying Bitcoin for a national strategic reserve, especially if China keeps coming out trying to attack it. I think it would be a smart move for the US government to buy the dip, especially if prices kept going lower. That would help to put a floor in it, and it's always a lot better to buy lows than the high. Plus, we're getting more and more institutions embracing crypto, even the traditionally conservative Vanguard, which for over a year has shied away from embracing crypto, even not allowing clients on their massive platform to buy crypto ETFs. Now all of a sudden, they've just done a complete backflip and going to allow their client to start buying Bitcoin ETFs starting tomorrow. Again, that could be a smart move. Much better to do this at the lows instead of the highs, which is a pretty good signal coming from one of the world's largest asset managers. And looking on many pricing models, some showing Bitcoin has rarely been this discounted relative to global liquidity and other technical measures. Because remember, global liquidity is on the rise. We've got fiscal stimulus coming not for the States, but Japan, Europe, China. Basically the amount of money sloshing around the world. And so we've got gold and silver at highs, tech stocks just sitting off highs, big dip in crypto, which just like gold and silver is an anti-fiat fixed supply currency. And so the more fiat there is around the world, the higher the prices of fixed supply assets should be, relatively speaking. And so I agree with Tom Lee. Crypto prices have fallen relentlessly, even as fundamentals measured by wallets, on-chain, fees, or tokenization have moved forward. The risk reward here is attractive for Bitcoin and Ethereum. And so one way I'm playing this is buying the dip on Strategy Stock, the largest Bitcoin treasury company in the world. With them too, buying more Bitcoin, raising cash, and currently trading at some of the cheapest valuation we've seen in about 3 years relative to the value of their Bitcoin. The market cap on their company is now about 85% of their Bitcoin holdings. You'd have to go back to the depths of the last bear market in 2022 to see a lower relative value. And there's a look at strategy on the chart today, printing a big bullish hammer candle with the biggest volume day since it last topped out in November last year. Remember, we can see elevated volume at tops and bottom. And so I added to my personal swing position the MicroStrategy leveraged ETF, which I previously said I would like to hold up to 3 months. However, I think it may need a little longer time than that before we can get back to some technically overbought levels with a premium valuation relative to its Bitcoin, maybe around 1.4 or 1.5. But again, this is just one of many positions I have. Important, you never go all in on any trade. Nothing's guaranteed to work out. I don't use margin. That's why I'm using this leveraged ETF, which can't go below zero. I also took it a step further and initiated a position in the leveraged Bitmine ETF today as well, which is the largest Ethereum treasury company with Tom Lee as the chairman, as they too currently have a market cap trading below the value of the Ethereum on their balance sheet. And there's a look at Bitmine Immersion Technologies, and I initiated a position just before close in the T-Rex 2x leverage Bitmine ETF, again with the view that I may hold it for a few months, potentially into Q2, Q3 next year, or even longer. As like I said, nobody can tell exactly when the bottom may occur. I just believe it's an attractive setup. Bit of a disconnect between the fundamentals and technical. 2026 could be a great year for crypto, even if it just catches up to other risk-on assets, gold and silver. I think the risk reward is there for potentially a good trade. So that's crypto. Just getting back to the stock market. First day of trading for December today. How's this month shaping up? Well, looking back in history, when the S&P 500 is up more than 10% year to date by the end of October, December is usually higher, 76% of the time, with good average gains of 2%. And looking back in last year, December actually finished lower. It's very rare we get 2 down Decembers in a row. You have to go back more than 10 years to see that. And so whilst December can be a bullish month, we don't really see that bullish seasonality until the second half of the month. So we could very well consolidate for the first 2 weeks. Then it's normally that Santa Claus rally that gives December good returns. And again, I believe the fundamentals are there. We're on track for a record holiday spending period. And just looking at the latest data from Adobe today, total season spend so far, $123 billion. That's up 7.2% year over year. They're really good numbers. And in fact, just looking at Black Friday stats, one of the biggest shopping days of the year, just set an all-time record for online spending, $11.8 billion in one day, which is almost 10% higher from the previous record, $10.8 billion last year. And so there's been a big narrative, the jobs market's about to fall off a cliff. Again, nobody knows for sure, but looking at forecasts coming from Goldman Sachs, they think the jobs market's actually stabilizing. We could see gains of 100,000 new jobs added to the US economy every month come May next year. Prospect of lower rates could very much help that be achieved. Along with that, they think we're going to see improved real income growth, and that's the growth in wages minus inflation, which is already well into positive territory. That could very well accelerate next year, which is good for the economy and should be good for stock market sentiment. If so, current leaders could further excel on the upside, like the stock leading this whole AI boom, Nvidia, which, believe it or not, is actually historically cheap, currently trading at 25 times forward earning, which is cheap for a stock that's been growing its earning at 65%, not to mention how robust and defendable those earnings are. I've seen the stock pull back and consolidate somewhat since releasing their bumper earnings. Did see a good buy the dip there last Wednesday. I think the stock's finding support here, and I wouldn't be surprised to see it back at all-time highs come Christmas or January next year, as the whole AI sector, along with crypto, has been having a bit of a pullback this last month or so. Interesting to hear Elon Musk say in a podcast yesterday, he sees opportunity in shares of Alphabet, Google, and Nvidia as attractive artificial intelligence stock investment. He thinks in the future, most market cap of the entire market will belong to AI, robotics, and space companies, which is hard to argue with, as AI and robotics will pretty much touch every industry out there. And so whilst I think we're in the early stages of the AI boom, you could liken it to the internet in the late 90s. Valuations did get ahead of themselves, for which there was a big correction in the early 2000s. But the boom in the internet has been a story of the past 30 years. Really kicked off in 95 when the internet went mainstream, finding its way into millions of consumers' homes. It's kind of what we've seen with chatbots the last couple of years. But how AI changes and shapes society, I think is likely to be a secular trend that could very much play out over the next 25 years. No doubt, with a lot of volatility along the way. But what we've seen the last couple of years is a big boom in mega cap tech, who've literally created this AI boom, really kicked it off. But now that's broadening out. Companies that are using AI and benefiting from it, allowing them to reduce labor costs, become a lot more productive and efficient, is starting to spread across the market. And so I agree with Goldman Sachs. One sector that could really set to benefit from this is small caps going into next year, which are forecast to grow earnings by a whopping 42% versus the NASDAQ 16% for next year. And that outperformance in earnings growth is set to kick off next quarter in 2026, coming at a time of a historic valuation discount of small cap PEs versus large cap and especially mega cap valuations. A huge mismatch between earnings growth and valuation, along with probably the most bullish Fed chair the market's ever seen. I think a lot of people don't realize how bullish Kevin Hassett, as possibly the next Fed chair, would be for the market. He spent his entire career arguing that the economy accelerates when capital stays cheap, and the Fed leans towards expansion instead of restraint. If Trump puts him back at the center of policy, then the person shaping rate decisions becomes someone who consistently pushes for easier financial conditions and faster growth. Leading a growth-first economic policy is about as market-friendly as it gets. They're going to try and outgrow debt. It's kind of the only choice. Most developed countries can't afford a recession and a pullback in tax receipt. They've got to run it hot. And that is historically great for small caps. They are much more sensitive to interest rate. Looking back in history, significantly outperform large caps when the Fed cuts rates. And remember, looking back in history, bull markets, which eventually turn into bubbles, don't historically peak till 6 to 12 months after financial conditions get tighter. In other words, when central banks raise rates. We've seen that time and time again, even looking back over 200 years. In previous bull markets and bubbles, once central banks raise rates, the bull market normally only has 6 to 12 months left in it as the cost of capital becomes too expensive. But we've got the exact opposite right now. We've got financial conditions getting easier, along with massive fiscal stimulus likely on the way heading into the midterm. Could very well potentially see refunds of tariff checks sent directly to Americans, along with new fiscal spending in tandem with monetary easing is a great setup for risk-on assets like small caps and crypto. And so I agree with JP Morgan's investment outlook for next year. Monetary and fiscal fuel is powering expansion. Never before have we seen fiscal deficits or rate cuts of this magnitude delivered outside of recession. And so looking at small caps, we've got increased earnings growth, a record valuation gap with large cap, lower interest rates, fiscal stimulus, AI productivity gains, all coming at a time of peak bearish sentiment in the market, the likes we've never seen before. Again, a huge disconnect. That all adds up to me as the ingredients for potential fireworks next year for small cap stock, which me and my members are already well positioned for. Got a few crypto stocks in my picks portfolio, along with AI infrastructure, rare earths, uranium, nuclear, fintech, a diverse mix of themes in small caps that are set to benefit from these easing conditions. With my stock picks portfolio already significantly outperforming the small cap index since starting, 49% time weighted returns versus 20% for the Vanguard small cap index fund. And so I can't wait to see how it does next year. And since I came back to do a video today, I've extended the Cyber Week sale until tonight only. So this is your opportunity to jump on board with me and join my stock pick service today and save 30% before the coupon code BTFD30 expires tonight. Just click the link below this video, head on over to my site, clickcapital.io, and join today. Then you can see all 37 small cap stocks I currently have in my portfolio, and you'll get my weekly pick in your inbox every Sunday. I invest in every pick myself with my own money the day after I send out the weekly pick on Sundays. Otherwise, that's a wrap for the daily market review today. Thanks for tuning in, and I'll see you back here again this time tomorrow. Cheers.